Hello and welcome to another video. In today's video, I'm going to break down my top 10 beginner investor mistakes. I, like everyone, was a beginner investing once, and I have made a number of mistakes along the way. So in this video, I'm going to break down my top 10 so that hopefully you'll make fewer mistakes and make more money along the way. So let's get going with the video. As always, don't forget to like this video and hit that subscribe button so you don't miss out on any further videos. So in at number 1 is investing before you're ready. I know that when I was younger and learned about investing, I got really excited. I just wanted to put my money straight into the stock market. However, if you are getting excited and you want to put your money into the stock market, hold on a second. First of all, make sure that your finances are in order. If you have high levels of debt that are really expensive, pay that off first. If you don't have an emergency fund, which is set up should an emergency hit, like damage to your house or you lose your job, get that set up first and then invest when you're ready. I, at the start of my investment journey, wanted to invest my money as quickly as possible. It meant that I just put my money out straight into investments and then realized that actually I probably needed some of that money to, pay for expenses along the way. So I'd recommend just sorting yourself out first, knowing how much money you can invest, and then investing once you're ready. I like to say that money in a bank account is doing nothing for you. However, if you're not ready to invest and that money isn't in the bank account ready for when you need it, then other issues may arise. Like you get into a debt spiral because you have to put things on credit cards. So just get ready before you start investing. Tip number 2 is setting unrealistic goals. When everyone wants to become an investor, they see the millions that people are making on Wall Street, in Mayfair, and think, hold up, that's going to be me in the future. It can be you, but it takes a significant amount of time. You're not going to be hitting home runs after home runs, becoming a tech entrepreneur and being a billionaire in no time. Often, the easiest way to make millions from the stock market is to be consistent, save small amounts each and every month. A more realistic goal than doubling your money every year is to look at your money as returning around about 7% a year. The stock market returns around 10% per year. However, if you invest in a diversified portfolio that includes stocks and bonds, you'll be looking at a lower return, such as 7% a year. However, that's sustainable and over the course of 30 or 40 years can grow significantly. I'll put links to my Instagram page below that I've highlighted how much you need to save every month at different ages to become a millionaire. It's really not as much as you think. An example which I love to tell people is that if you want to retire as a millionaire at the age of 65 and you haven't invested in your life until the age of 30, you will only have to save just over £600 a month. At a return of 7%, you will hit that million mark when you hit 65. Whilst £600 a month can seem expensive, I'm just saying that that number is achievable. It's not as if you're having to put tens of thousands of pounds away every single month to become a millionaire. £600 is a much more believable number than hundreds of thousands of pounds to become the next millionaire. So just remember that when you start investing. And number 3 is trusting external sources too much. I appreciate when you're a beginner, you go to experts to understand exactly what they're doing because quite frankly, you don't know what's going on. However, I would recommend that you don't just blindly follow experts. Even the best investors, such as the Warren Buffetts and Charlie Mungers of the world, make mistakes. You really need to understand the expert's position. Sometimes these experts can go on TV selling a stock just because they own that stock and they love it. So always understand their incentives. Don't just blindly follow anybody. Don't blindly follow your parents, your friends, some talking heads on YouTube, as well as financial experts. Make sure that you always do your own research. And this brings me on to number 4, research. Research is key. I appreciate when you're a beginner, you're not necessarily sure what you're looking at. So that's why I take it really slow and really understand what you're investing in and understand how, say, a company makes money. I appreciate researching financial assets takes time and is difficult. So just remember that next time you're investing, you're thinking, wow, this is seriously hard, you really get an edge on all other people. It also means that you're not just blindly following people. If a friend comes to you and says this is a great investment, when you research it, you can make that call yourself so that in a couple of years' time, your money hasn't been lost. Most individuals who I know, and I'm sure you guys know, will put more research into finding a TV than they're willing to their finances each year. However, buying a TV isn't going to make you rich in the long term. So really make sure you do your research. I appreciate this is hard as a beginner investor as there's so many different investments out there. However, just start slow. It's not a race. You've got your whole lifetime ahead of you. Really understand what's going on before you invest, just to think that that money you won't see for another few years. Number 5 is under or over diversifying. So you've done all your research, you're comfortable with an investment. You're now ready to put your money into an investment. However, you don't know how much money you should be putting in. But because you've done so much research, you're confident that this company will be a great long-term investment, that the money that you're going to put in will multiply 10, 20, 100 times. But stop. Before you go any further, let's talk about diversification. Diversification is just essentially don't put in all your eggs into one basket. A lot of beginner investors get overexcited and put too much money into one investment. This might mean that your portfolio has one investment which represents 50% of your entire portfolio. You might have done all your research and feel super confident. However, if that investment goes down significantly, you've lost a significant portion of your net wealth. So just make sure that you don't put all your eggs in one basket. This can also go the other way, as investors may not know what stocks, what companies or sectors they should be investing in. This means that they scattergun, pick lots of different investments in lots of different sectors. This means that sometimes they can hold hundreds of stocks in hundreds of different companies. This means that they can't actually track exactly what each company is doing or how each company is performing. And if one company does really well, then they actually don't benefit from that company performing really well. Instead, they've got more like an index fund, which is just tracking a whole index of companies. For investors who want to get access to lots of different companies, an index fund is a much better route. I'll put a card up to a whole video that I've got about exchange traded funds, which introduce you to funds which track a whole index, such as the FTSE 100 or the S&P 500, which is a ready-made, diversified investment which has access to some of the largest companies in the world. As a general rule that I use, I ensure that no single investment is more than 10% of my entire portfolio. And when I initially buy an investment, it's no more than 5%. I choose this 5% because if an investment goes down, and I've done all the research and I'm confident that it'll be a great long-term investment, then it just means that I can buy more of it cheaper. So if it goes down, I can buy more and more. And once I hit that 10% limit, I stop. Therefore, it means that my portfolio holds around 10 to 20 different companies at any one time. And number 6, I have trading too much. I have a video that talks about the difference between trading and investing. However, as a beginner, you often see a gain and want to cash out. The main thing to do is stay calm and don't panic. If your investments are gaining money, then great. If they're losing money, just remember why you invest in that company in the first place. By trading a lot, if you don't use a free platform, such as Trading 212 or Free Trade, then you will be charged commission every single time that you trade. This can quickly eat into any returns. Just remember that you're investing. You're buying something now and holding it for a long time. Therefore, you shouldn't worry about the small deviations in price. Just set yourself a limit, buy the stock and hold for the long term, enabling you to benefit from the long-term capital appreciation and dividend payments. Next up, at number 7, we have dealing on emotions. One of the best and worst things about the financial markets is you get immediate feedback of the price going up or down. It means that you can be extremely happy when the stock's going up, or you could be extremely sad when your stock is going down. Investing is far more psychological than most people give it credit. What you really need to do to be a great investor is to take your emotions out of the equation. If the stock market goes up, understand why the stock market has gone up. Sometimes it can be something that's completely out of the company or your control. So whilst you can be happy that you've made money, equally don't be sad if you're losing money, because again, that is out of your control too. You don't know what's going on in the world, and this can be as a result of a pandemic or a financial crisis. You just need to truly understand what is going on. If something is company specific, I don't know, such as an accounting scandal, then maybe you do want to sell. But if you see your investment go down a couple of percentage points, just understand that movements of say 5 percentage points, either positive or negative each day, are actually quite common. So if you see your stock go down, don't panic and don't sell. Emotions get the better of all investors regardless of their age or experience. Just appreciate that next time and just be aware of it to make sure that you're not buying or selling on emotions. Point number 8 is buying high and selling low. Sounds super obvious, but very similar to when people deal on emotions. A lot of investors at all experience levels do this. Often, an investor will be reading the news, see extreme gains from a stock. They'll also see that other investors have invested in a certain stock and don't want to miss out. They'll float into an investment that's already gained significantly and buy it when the price is touching or at an all-time high. Next, when the outlook of that company changes and it turns negative, the stock market turns negative and it reduces significantly, they panic, thinking it's over, the company's no good, and they sell. So always remember, buy low, sell high. If the world is watching a particular stock and there's lots of hype about a certain company, try and understand that, is it worth it? Is it overbought and the price is too high? Or is it actually an exciting prospect? That's when doing your research is key. But always remember, buy low, sell high. Don't buy high, sell low. That's a sure way to lose money. Number 9 is trying to time the market. If you're any sort of investor, you've looked at the charts of a certain stock and you've seen that it's probably gone down, up, down, up. Every investor wants to time the market. They want to buy that very bottom point. I've done it myself where I've looked at a certain investment and said, I'll buy it once it goes cheaper. Once the price goes down, I'll buy it then. I've done all my research. I've said, this is a great company. I want to hold it, but I want it cheaper. And then all that happens is a stock doesn't go cheaper and doubles in price. There I've missed out on holding a great company and the stock doubling in price. So I'd recommend to all people, once you've done your research and you're comfortable with a company or a certain investment and you're happy with the price that it is right now, I would always just think buy it, because if it gets cheaper, better. But therefore, you're not missing out on any long-term gains. Timing the market is so hard that professionals struggle with this too. So don't worry about timing the market, just focus on buying great investments that you're going to hold for a long term. And finally, point number 10 is not having a clear investment strategy. I appreciate you're an investor and you might not know all the different investment strategies there are out there. However, when you start to invest, just start with things that you know. Don't focus on learning about all the different companies in the world. Maybe start with companies that you know, or companies in sectors that you work in. If you work in a supermarket, maybe have a look at the supermarkets. You'll understand them a bit better and it will enhance your education so much more than if you just pick random companies in random sectors which you don't really understand or you don't even have any interest in. So getting that interest in the company or investment that you're going to buy is key. It will accelerate your learning and make you a better investor quicker. So there are my top 10 tips. To me, investing is great and I encourage absolutely everyone to invest in financial markets. I appreciate as beginners, there's a huge world out there and you will probably make a lot of mistakes along the way. Believe me, in that top 10, beginners and professionals make those mistakes all the time. But I hope that you can take away from this video a few mistakes which you hopefully won't make, which will make you a better investor. I cannot stress enough the need to keep learning about investing and always do your own research. Read financial books, read the financial news, and learn from the best investors in the world who have made millions, if not billions, off investing. I hope you've enjoyed this video and learned a few techniques about different ways to make yourself a better investor, which will hopefully save you money in the long term. As always, make sure you hit that like button and hit that subscribe button so you don't miss out on any further videos. And I'll see you next time.